Q1 2022 has been an odd quarter. For most investors, it was a quarter to forget, unless you were invested in one specific asset class. Now, geopolitical events have dominated the headlines. However, it is the inflation story as well as the interest rates that are based off the inflation levels that are going to be the focus of asset prices, thereby their asset returns in the years and the quarters to come. Greetings, viewers. You're watching Aman Sanga, independent financial advisor in Mississauga, Ontario. For my update for the month of March, as well as for Q1 2022, I will break it up as always into three components. We'll start with the index returns, which is the foundation on which both the inflation and the portfolio positioning part of the update are based on. So without further ado, let's start with the index returns. And what you can see is that there is a lot of red for bonds and a lot of red for equities as well. Now, if you were a bond investor, this was definitely an quarter to forget, and we'll come back to that shortly. The only glimmer here right now is the TSX, which is based on the commodities, which we'll again visit it in just a few moments. Now, the good picture, I think, in all of this is the story coming out from emerging markets, which is really like the last week of the quarter, where there seems indications that China is likely done with the tech crackdown that we saw in the past year. And we could see good news coming out of this segment going forward. Now, with that, let's look at how the quarter was for the bonds investors. And you can see the severity of the decline. And if you have to see any parallels for that, you have to really go back to the early 80s to see those kind of drawdowns for bond investors. Now, I said if it was a good quarter if you were invested in commodities, and again, to see the kind of positive returns we had for commodities this quarter, you have to go back to the US-Iraq war to see this, to see any parallels to the spike in prices that we saw in the levels for commodities. Now, this is all history. Like, what does this mean going forward? Like, what do we go from here? And a lot of that narrative is based on how well or how we capture inflation or how we are able to tackle inflation. For my Feb update, I had delved into the US numbers. And for my March update, I'm sharing the Canadian numbers, and you can see that it continues to be high. And the three components of food, shelter, and transportation are all contributing towards higher inflation. So the story is not about is inflation transient or not, but for how long will it stay to these levels before it returns to the targeted bands by central bankers, which are generally between 1% and 3%. So again, at this point, I'm going to switch to US. This is the rate hikes that are projected or priced in from the Federal Reserve between now and early 2023. And you can see that there are about 6 to 7 hikes of 25 basis points that are being priced in. And higher rates means lower growth rates for the economy. And again, this is going back to where we started, that this is coming off higher inflation levels that are expected to persist much longer than they were earlier anticipated. Now, this is the main question. If rates are rising, does it mean that a recession is imminent? And that's the main question that I'm getting, and I'm trying to address this in the subsequent slide, that the best predictor for inflation, for recession, is generally believed to be the 10-year, 3-month yield curve. And you can see this plot as of April 1st, this is still positively sloped, and the value stood at 1.85. So if we have 6 or even 7 rate hikes of 25 basis points and everything else remains constant, this value will still be positive. And even if it were to turn negative, a recession is followed by, there is a gap of about 6 to 7 months before recession ultimately kicks in. So the point is, the question that we're getting is, should I move to cash? Should I liquidate some of my holdings? And that's what I'm trying to address here, that, and it's not like you can rule out recession entirely, but based on prior experiences, it looks like the chances of recession are low till now. Now, in this environment, like what are the areas which are likely to benefit? And definitely with sanctions on Russia, a lot of commodities, there is a big gap for commodities, and a lot of that gap is filled by what is produced in Canada. So Canadian price commodity companies or equities are going to be beneficial of these higher prices for commodities. So for the next foreseeable future, Canada would be a good place to be in as long as these prices stay higher. And lastly, even if we look at a macro picture, when we have had a bad start to a year like the one we had in 2022, if history is a precedent, if you use it as a precedent, most of the times, I'm saying most, that's 4 out of 5 times, when we had a bad start to the year, end of the year was at a price level much higher than the drawdown or where the year started out to be. And again, this is not all the times, it's most of the times. So if you're optimistic about your outlook and believe that this is the war eventually will settle itself out and the supply chains will even out and will go back to pre-COVID lifestyles, I think you should stay the course, stay invested, whatever your targeted goals were. If you can add more money, take this opportunity or this drawdown to put some money in. For the worst case, I would never recommend suggest selling at a low. Stay the course, whatever your plan is. And if you need any help with any of your goals or discussions or how to position your portfolios, you know the number to call, 905-363-5035. Thank you so much for watching, and bye for now.